So you don't pay much attention to the dismal scientist then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, you know, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's, you know, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that, you know, if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, you know, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough.
Farmer apartment house, you don't get a quote on those every day or every week, and I think you look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in the 2-month period if you're looking at it as a business. Now you've got, anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open to borrow money. You can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like
and
the volatility index and things that are tied to that.
The idea of people taking a position, and they're gambling, they're not investing. Nobody's investing when they buy, you know, some supercharged index on, you know, on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, you know, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise, you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, you know, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean,